This year has been incredible for the market as the S&P 500 was up around 16%. It was an even better year for Barron's as they beat the market with returns of 27.9%, with picks such as Alibaba and Google. They've recently published their top 10 investment picks for 2026, and I'll be analyzing each one to determine whether it makes sense as a buy at today's price. And the first one is Amazon, which analysts have it rated as a strong buy with 23% upside. It has a market cap of $2.4 trillion, which makes it the fifth largest company in the world. They are currently trading at a forward P of 31, but we'll see more on the valuation later with the discounted cash flow model. Amazon has seen exceptional revenue growth in the past decade, growing from $107 billion to 691 currently, and analysts are still expecting tons of revenue growth as they have Amazon reaching $729 billion this year and reach $1.2 trillion in revenue by 2030. Their profit in terms of net income has seen good growth, especially over the past 3 years, and it is currently at $76 billion. On the other hand, their free cash flow hasn't seen the same growth, and they are currently making $10 billion. The reason Amazon's profit looks low compared to its revenue is because the company spends a lot of money on growth. Amazon puts a huge amount of cash into building more warehouses, improving automation inside those warehouses, and expanding its delivery network with vans, planes, and trucks. All of this helps Amazon deliver faster and stay ahead of competitors, even if it lowers profit in the short term. This can be clearly seen in this chart, which breaks down the operating expenses. This is also why their margins are either around 11% like their current profit margin or 1.5% like their current free cash flow margin. Analysts are expecting very high profit growth as they have Amazon making $7.28 per share this year and grow to $17.17 per share in 2030. If you assign a 25p to the company then, it would make it a $429 stock, meaning 85% upside from current levels, so great returns according to analysts. Then, in order to calculate the intrinsic value of the company and potential future returns, I use my Google Sheet, which tells me at what price you should buy a stock based on the assumptions about the future of the company that you put in. I did a 7-year analysis with low, middle, and high assumptions. And as you can see, the intrinsic value according to my low assumptions is $99 per share, middle $179, and high $284. And because the stock is currently trading at $231, this means that if my low assumptions occur, you would get a negative 3.6% annual return on your money, middle positive 5.7%, and high positive 13.65%. Now, as far as my assumptions, I assume Amazon grows revenue between 8 and 12% over the next 7 years, the average of profit margin between 6 and 12%. This is obviously the hard part about valuing Amazon, but this is what I believe they'll do on average in the next 7 years, and I assigned the PM price to free cash flow at the end of the 7 years of 22, 24, and 26 because I believe Amazon deserves a premium over the market average of 16. Moreover, Amazon is trading at a P of 32 and price to free cash flow of 233, and therefore in my opinion, Amazon is trading a bit expensive at the moment. Moreover, Amazon has a very good balance sheet as they have $94 billion in cash and $160 in debt, which is nothing for a company that has a market cap of $2.4 trillion. 3 more positives that I want to mention in Amazon's favor are AWS, advertising, and international growth. AWS has been growing very fast in the past years. Last quarter, it grew by 20%, and this is a very high margin business. The same goes to their advertisement segment. And Amazon also still has a lot of room for growth internationally, as it is currently making $154 billion, while the US $414 billion. And in conclusion, I believe Amazon is a fantastic company that still has a lot of room for growth, despite being a $2.4 trillion company. However, I think it's trading a bit expensive at the moment, and there are better opportunities in the market right now. Stock number 2 is Bristol Meyers, which is down 4% year to date, after a recent run-up of 9% in the past month. Analysts have them also rated as a buy. They are currently trading at a forward P of 8 and they pay a dividend of 4.6%. This is a pharmaceutical company, which their value is based on the strength of their patents. And analysts are very pessimistic about the future, as revenue is expected to decrease from $48 billion to $36 in the next 5 years. and profit is also expected to decrease from $6.59 per share to $5.18. Barron also notes BMY could emerge as a potential buyout candidate if the turnaround fails to materialize organically. They also have a substantial amount of debt, as they have $51 billion in debt and $16 billion in cash, which is a lot for a company that has a market cap of $109 billion. And in conclusion, I think pharmaceutical companies are very hard to value, and I don't like to rely on possible buyouts as an investor, which is why this stock is a pass for me at the moment. The stock number 3 is Comcast, which is down 41% in the past 5 years and trading at a P of 4.9, which is one of the lowest multiples in the S&P 500. They also pay a dividend of 4.4%. This is a media and technology conglomerate, and they have seen good revenue growth in the past decade, growing from $74 billion to $123 billion. However, it has stagnated in the past couple of years, and analysts are expecting slow revenue growth in the next 5 years as they have them reaching $135 billion in 2030, which is a compounded annual growth rate of 4.3%. Their profit has also seen decent growth from $8 billion to $22 billion, and free cash flow from $10 billion to $20 billion. So Comcast has very good margins with gross margin around 71%. Profit margin and free cash flow margin has been between 12 and 18%. Another positive about their financials is that they have been buying back a lot of shares recently. This is very positive for investors as you own more of the company and share the profits with less people, basically by doing nothing. Like revenue, analysts are expecting very little profit growth in the next years, growing from $4.35 per share to $5.31. If you assign a 10 P to the company, then it would make it a $53 stock, meaning 77% returns from current levels, which is solid. And as you can see, according to the discounted cash flow model, the intrinsic value is 35 according to my low assumptions, middle 51, and high 72. And the stock is currently trading at $30 per share. Therefore, if my low assumptions occur, you would get a 13.5% annual return on your money, middle 22%, and high 30%, which are amazing returns, and the stock looks very undervalued. And I believe my assumptions are reasonable as I have the company growing revenue between 1 and 5%, averaging a profit margin and free cash flow margin between 12 and 16%. I assigned the P/E price to free cash flow at the end of the 7 years of 7, 9, and 11, and I didn't even assume any share buybacks to be more conservative. But if you want to make your own assumptions, I'm going to leave a link to the spreadsheet down below. It is super simple to use because I've done all the calculations in the background, so you only need to input your assumptions. By the way, these returns include a dividend, which currently has a yield of 4.4%. The reason we have to include dividends in a discounted cash flow model is because dividends come from profit, so you cannot double count them. By the way, the payout ratio is 21%, which is what percentage of the net income is used to pay the dividend, and therefore it is a safe dividend as it is under 50%. My biggest issue with Comcast is their balance sheet, as they have $9 billion in cash and $99 billion in debt, which is a lot for a company that has a market cap of $108 billion. Barron's thesis is that the market has become overly pessimistic about the competition, and I think the valuation is very attractive, but because of the amount of debt, I am going to pass on this company for now. Next stock they have on the list is Exxon Mobil, another company trading at a fairly low multiple of 17 that also pays a dividend, in this case a yield of 3.4%. Exxon Mobil Corporation engages in the exploration and production of crude oil and natural gas, so their revenue and profits are reliant on crude oil prices. I actually believe the oil sector is very cheap right now. To understand the opportunity, let's quickly break down how the oil industry works. There are 3 main segments. Upstream, these are the companies that extract crude oil from the ground. Midstream, companies that transport oil, usually through pipelines. And downstream, that refine crude oil into usable products like jet fuel, diesel, and gasoline. Big players like Exxon Mobil operate across all 3 sectors. I am personally bullish as well on the oil sector, because looking at the last 5 years of inflation-adjusted oil prices, we are currently in the lower part of the cycle. Now imagine what happens to oil stocks if oil prices move from around $57 barrel to $80. Not even a crazy high number historically. However, where I see a huge opportunity in this sector is in the smaller upstream producers, as they are trading at incredibly cheap valuations, at multiples of around 4 or 5, while Exxon Mobil is trading at 1 of 17. And it looked a bit expensive in the discounted cash flow model. As you can see, intrinsic value of 57 according to my low assumptions, middle 93, and high 141. And because the stock is currently trading at 120, we have returns of negative 2.9% according to the low assumptions, middle 5.4%, and high 13%. And like I always say, the market gives you around 9 or 10% per year, which is why it's the return I always put to calculate intrinsic value. So in order to justify buying an individual company that has more risk, you need at least 13% in my opinion. And in conclusion, while I agree with Barron's view that the oil sector is undervalued, I just believe there are better opportunities out there in the sector. I made a video not so long ago in my channel in case you want to check it out. The next stock I'm going to cover is Visa stock, which is up 11% in the past year. Analysts have them also rated as a strong buy, and they are trading at a forward P of 27. Vista's financials are exceptional. The revenue has grown from $11 billion to $40 in the past decade. Their net income from $5 billion to 19, and they have even more free cash flow, currently at $21 billion. Their margins are also exceptional, with gross margin at 97%, profit margin at 49%, and free cash flow margin at 53%. Which is why it is no surprise that analysts are expecting double-digit growth both in profit and revenue in the next years. And they also have an amazing balance sheet with $19 billion in cash and $27 billion in debt, which is nothing for a company that has a market cap of $670 billion. They are also growing in every single metric, such as total payment volume in both US and international, in total transactions and total cards. Visa is a quality company that I want to own. The only question that remains is, can I pay a reasonable price in order to make a good return on my money? In order to answer that question, we have the Google sheet. And as you can see, the intrinsic value according to my low assumptions is $235 per share, middle 307 and high 396. And because the stock is currently trading at $351 per share, means that if my low assumptions occur, you would get a 3.2% annual return on your money, middle 7.7%, and high 12.1%. And as far as my assumptions, I think they are reasonable, as I have Visa growing revenue between 8 and 12% over the next 7 years, averaging a profit margin and free cash flow margin between 48 and 56%. And I assigned the PM price to free cash flow at the end of the 7 years of 20, 22, and 24 because Visa definitely deserves a premium. And in conclusion, this company is fantastic and is getting close to my price target, which is around $300 per share. If you're serious about investing, you know that picking the right stocks isn't just about the story, it's about mixing it with the numbers. And that's exactly where stockanalysis.com comes in. This site lets you go deep, track up to 10 years of historical financial performance, see revenue, profit, margins, dividends, everything. If you want a discount code, you have mine in the description. And they also have a free newsletter that highlights important market moves and stock market fundamentals. Perfect if you want to stay informed without spending hours digging through data. The last stock that I'm going to cover in this video is Disney, a company that has been struggling as it is down 37% in the past 5 years. Another company with analyst rating as strong buy, a forward P of 17, and another company that pays a dividend, in this case 1.3%. So we can definitely see a pattern in the stocks Barron has chosen for the year. Disney has seen good revenue growth in the past decade, growing from $55 billion to $94 currently, which includes a couple of years in which parks were closed due to the pandemic. Analysts are expecting low single-digit revenue growth for the next 5 years, and the biggest issue with Disney in the past was their profit. As you can see, it took a big hit, and unlike revenue, it wasn't recovering. However, they have been recovered in the past year, and they are currently at $12.4 billion in net income, which is almost at an all-time high. The same story happened with free cash flow, although it is a bit lower today at $10 billion. And obviously the same happened with their margins, and they have now recovered. Analysts are expecting slow profit growth, as they are expecting Disney to make $8.86 per share in 2029. If you assign a 20p to the company then, it would make it a $177 stock, meaning 55% upside from current levels. Disney has recovered and they are now growing in every segment again, which is entertainment, parks and experiences, and sports. They do have a bit of debt, as they have now $45 billion in debt and the market cap is $203 billion. And according to a discounted cash flow model, we have intrinsic value of 79, according to my low assumptions, 121 according to the middle, and 174 to the high. And because the stock is trading at 114, the returns are 3.4 according to my bear case, 11.1 according to my base, and 18 according to my bull case. So it looks like Disney is trading around fair value, but in order for me to buy, I need more margin of safety, probably under $100 per share. Let me know if you enjoyed this type of video where I cover multiple stocks. The reason I'm not going to cover the other 4 companies is because some of them are REITs, one is an insurance company, and another is unprofitable. These types of businesses are very hard to value, and covering them properly would make the video much longer. I hope you found this video valuable. Let me know what you think about these stocks in the comments, and I'll see you in the next one.